Hello everybody, it's Yashar here, back again with another video, and in this video we are diving deep into a stock that touches almost every Canadian household, Loblaw Companies Limited. I bet you know at least one of their retail stores or products. Loblaw's, President Choice, PC Optimum, No Frills, No Name Brand, Real Canadian Superstore, Shoppers Drug Mart, and so on. They are everywhere. But does that translate into a good investment opportunity for you? That's what we are going to explore today. Stick around because by the end of this video, you will have a much better idea about Loblaw's stock and whether it belongs in your portfolio. I will discuss their business, their competitive advantages, the risk associated with this stock, and finally I will provide a detailed stock analysis using my personal discounted future earnings model and will then provide you with the fair value of the stock depending on your investment goals. The company HQ is located at Brampton, Ontario, and their shares are traded on TSX for almost 222 Canadian dollar at the time of recording this video. They pay a dividend with a starting yield of almost 1%, and the market capitalization of the company is around 66 billion Canadian dollar. The stock had an amazing run in the past couple of months, and it is up 38% in the last year alone. It is more impressive in the last 5 years. The stock is up 233% in the last 5 years. And that's an absolutely amazing performance. For those of you who are not familiar with this company, Loblaw Companies is Canada's largest food and pharmacy retailer. They operate a vast network of stores under different brands like Loblaw's, Atlantic Superstore, Wholesale Club, No Frills, Value Mart. Beyond groceries, their acquisition of Shoppers Drug Mart has also been a game changer for the business, giving them significant footprint in pharmacy and healthcare service sector. They also have a financial service arm with their PC Optimum loyalty program, and finally they have a fashion and beauty division with the brands like Joy Fresh and Beauty Boutique. Essentially, Loblaw is a consumer defensive powerhouse in Canada. Loblaw has seen some impressive performance recently, so let's look at some key financial highlights from their recent Q1 earnings report. So their revenue was up 4.1% year over year. Their EBITDA growth was 3% year over year. Let's talk about their same store sales. Their food retail business saw a 2.2% growth and their drugstore saw 3.8% growth. Usually their e-commerce business and their e-finance business grows faster than this, but the main pillars of their business is retail. They had lower capex, some additional share buybacks, and a 10 basis point better operating margin, and therefore the adjusted EPS per share increased by 9.3% year over year, which is great. Like every other business, there are goods and bads with Loblaw's. Organic fundamental business growth is, as you can see here, minimal, something close to 3 to 5% year over year. But Loblaw's has a dominant market position here in Canada. They are Canada's largest grocery and pharmacy chain. They have economies of scale. As it is a defensive stock, in times of economic uncertainty, their items remain in high demand, making this company a relatively stable cash flow generator. The stock therefore should trade for a premium. However, if we look at the historical price multiples of Loblaw's, they were never traded close to these valuations before. In fact, their 5-year average price to earnings ratio is close to 22.2 and their current price to earnings is 30.8. Their price to cash flow is currently at 13.6 while their 5-year average is just 8.1. Even if you look at the price to sales, we see the same story. Current price to sales is 1.1 while the 5-year average of the business is 0.6. Loblaw is trading at a significant premium today compared to the historical values. Therefore, we can see that most of the growth in the stock price of the company in the last year, it didn't come from an amazing organic growth of the business, but it simply came from significant multiple expansion. I will talk about the valuation more towards the end of the video, but let's talk about some risks of investing in this company. I think the number one risk for any retailer is inflation and tariffs right now. While they have managed to pass on some costs to consumers in the past, rising food prices can impact consumer spending habits and put pressure on the margins of the business because they also have to compete with other major players like Metro and Sobeys, Dollarama, Costco, and Walmart in Canada. Second major risk for a company like Loblaw's is regulations. As a grocery store chain, usually faces both public and governmental scrutiny over pricing, especially during periods of high inflation. The last but not least is pricing power. They have a scale, but I don't think they have much pricing power, which can be challenging for predictability of the growth rate of the business in the future. Consumers focus on lower prices during difficult times, and this has forced Loblaws and its peers to keep investing in lower prices to stay relevant, and it leaves little room for pricing power for such a business. Okay, with all this information in mind, now let me go through the valuation of Loblaw Company's stock using my own model. To start building the model, I imported a series of general parameters from Loblaw's earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash or cash equivalents, and their net earnings per share. I also put my expected rate of return to be 10% for this stock. I usually use 12%, but just for the sake of demonstration, let's stick with 10%. Now in this model, I will calculate the fair value of the stock by projecting their future net earnings and then discount the terminal value and future earnings minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I considered 0% share-based compensation, 0% share dilution, and I assumed they are able to grow their revenue by 4% in the short term, 3% in the midterm, and eventually by only 2% in the long term. And I considered a terminal multiple of 16, which is in agreement with historical bear periods in this company. For base case or normal case, I considered a little bit better margins and normal revenue growth in line with analyst expectation and company management team guidelines, and a terminal multiple of 23, which is historically an average multiple for this stock. Finally, in the bull case or best possible outcome, I considered a little bit profit margin expansion, a 0% share dilution, 9% short-term, 7% mid-term, and 5% long-term growth, and a terminal multiple of 30, which is a bull multiple for this company. Note that these assumptions in the bull case are pretty dramatic in my opinion. This is even better than what management team at Loblaws predicts, and it's better than analyst expectations for the growth of the business, which should be around 5% in the short to medium term. I also considered a price to earnings of 30, which is equal to the current earnings multiple of the company, and we all know that the current PE of this stock is at an all-time high. Now, with all that optimistic numbers, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. First of all, it gives me a tip. Net debt of the business is high compared to its future cash flows, so you may want to adjust the model to take this into account. It basically tells you that this business has significant debt on its balance sheet compared to its future earnings, and therefore you probably want to increase your margin of safety in your calculations. I usually do this by increasing my expected rate of return. For now, I ignore this. Okay, next it gives you the intrinsic value of the stock in each scenario. And then it will provide you with a fair value estimate, which is 112 Canadian dollar per share for Loblaws. And comparing to the current share price of $220, Loblaws trades at almost 50% premium today. There is a tech reviewer that I really like him on YouTube, Flossie Carter, and whenever he reviews a smartphone or laptop that is too expensive, he uses terminology that the price is too goddamn high. I should use the same terminology for Loblaws here. The share price is just TGH, too goddamn high. It is not a buy according to the model. It means based on the current assumptions I have here, which are optimistic to begin with, the Loblaws stock is not even able to return 10% per year in the next 10 years. The price should be cut in half before I even start to look at the business. You may say, this is crazy, Usher, it never happens. Look at my old analysis of Algonquin Power and Northland Power. I also predicted those stocks are expensive by 50%, and what happened was that the stock price for those companies crashed by more than 50% in 2 years, and they had to cut their dividend. I'm not saying Loblaws share price will crash dramatically like those two companies, which they had bad financial balance sheet to begin with, but I would simply say that you should not expect much capital appreciation if you buy Loblaws here. And your only hope is that the earnings multiple expansion continues, which is hard to go higher than this, as it is already pretty inflated compared to historical price multiples. For me, Loblaws is a pass at these price ranges, and I would stick with my alimentation Couche-Tard shares as a similar business but at a much more attractive valuation. Loblaws is a good business, but I personally would not pay such exuberant premium for a slow-growing business like Loblaws. And I will prefer to wait. If the price never comes down to my target price, I'm still okay. I'm investing in other businesses which have better valuations, at least in my opinion. There you are, guys. I hope you enjoyed the video. And if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you guys in the next video. Farewell.